Did you know that the one person you trusted most with your retirement, your own financial advisor, could actually be quietly costing you tens of thousands of dollars in Social Security benefits? And the worst part is, they're not even breaking the law to do it. I've spent years sitting across the table from retirees in their 60s and 70s, watching the same thing happen over and over again. Smart people, hardworking people, people who did everything right. And still, they walked into traps the Social Security Administration set decades ago. Traps their advisor never once mentioned, because mentioning them would have cost the advisor money. Today, I'm going to walk you through 5 hidden Social Security traps your financial advisor won't show you, with real numbers, real forms, and real case studies from people just like you. And because this topic is so dangerous, I'm adding 2 bonus traps at the end that almost nobody on YouTube is talking about. Trap number 7, in particular, could put an extra check in your mailbox every single month, from someone who will never even know they're paying you. Type 1 in the comments right now if you've ever been told to just wait until 70, without anyone showing you the math. I want to see how many of you this has happened to. And before we start, a quick note. This is educational content, not personalized financial advice. Every situation is different. Always verify with the Social Security Administration directly, or with a fiduciary who legally works for you. Now let's open the first trap. Trap 1, the advisor incentive trap. Meet Mr. Reynolds, 68 years old, retired high school history teacher from Columbus, Ohio. 32 years in the classroom, 2 grown kids, a paid-off house, and roughly $800,000 in an IRA. He built one small contribution at a time. When Mr. Reynolds sat down with his advisor at 62, he asked a simple question. When should I claim Social Security? And the advisor, nice man, nice office, framed certifications on the wall, said the same thing advisors say every single day in this country. Wait until 70. You'll maximize your check. Here's what the advisor didn't say. Most financial advisors in America are paid through something called AUM, assets under management. That means they charge you a percentage, usually around 1% of the money they're managing for you, every single year, whether the market goes up, down, or sideways. Now watch what happens. If Mr. Reynolds claims Social Security at 62, he starts pulling roughly $24,000 to $30,000 a year from the government instead of from his portfolio. His IRA shrinks slower. That sounds great for him, but for his advisor, that's a slow bleed on their paycheck. But if Mr. Reynolds delays until 78 full years, he has to spend his portfolio to cover his living expenses in the meantime. That keeps his IRA balance artificially high for almost a decade. 1% of $800,000 is $8,000 a year. Over those 8 years of delay, that's roughly $64,000 in extra fees flowing into the advisor's pocket, on money that was supposed to be protecting Mr. Reynolds. Let me say that again slowly. The advice to wait until 70, in many cases, puts around $64,000 extra dollars into your advisor's pocket, not yours. And here's the phrase I want you to write down. Fiduciary versus suitability standard. Pause the video if you need to. Google it tonight. A fiduciary is legally required to put your interests first. A suitability advisor only has to recommend something that's suitable, which is a lawyer's word for not obviously terrible. Most of the people you think are fiduciaries aren't. They just sound like it. Your advisor isn't lying to you. They just happen to get paid more when you follow their advice. And that, my friends, is a trap nobody ever puts in writing. But wait until you hear what Congress did in 1984. Because that trap is still eating your check today. Trap 2, the 1984 tax trap. Meet Mrs. Dawson, 72 years old, retired registered nurse from Sarasota, Florida. Her husband passed 3 years ago. She lives on a modest pension, a small annuity, and Social Security. Total income around $52,000 a year. Not rich, not poor. Middle class, the way middle class used to mean something. And every April, Mrs. Dawson pays federal income tax on up to 85% of her Social Security benefits. When she found out, she called me and said, word for word, "Honey, I paid Social Security taxes out of every paycheck for 41 years. Now they're taxing me again? How is that legal?" The answer is the 1984 tax trap. Here's how it works. When Social Security benefits first became taxable under a law signed in 1983, Congress set two thresholds based on something called provisional income. If you're single and your provisional income goes above $25,000, part of your benefit becomes taxable. If you're married filing jointly, the threshold is $32,000. Now here's the punchline. Those numbers, 25,000 and 32,000, have never been updated. Not once. Not for inflation. Not for cost of living. Not for anything. They've been frozen in place since the year of the first Macintosh computer. $25,000 in 1984, adjusted for inflation, is roughly $76,000 in today's money, which means the threshold has effectively dropped by about 2/3. Congress set this threshold in 1984, the year of the first Macintosh. They've updated the iPhone 17 times since. They've never updated this. Back then, only about 10% of retirees paid any federal tax on their Social Security. Today, more than half of all retirees do. Not because retirees got richer, because the finish line got secretly moved closer while nobody was looking. And your advisor almost certainly did not explain this to you, because there is nothing they can sell you to fix it. They can't put this threshold in a product. They can't charge a percentage to make it go away, so they don't bring it up. Now, there are legitimate tools to manage provisional income. The timing of withdrawals from taxable accounts, qualified charitable distributions directly from an IRA after age 70 and a half, careful use of capital gains harvesting in low-income years. But step one is knowing the trap exists, because if you don't know the rule, you can't play around it. Mrs. Dawson didn't know. Most retirees don't know. That's how the trap keeps working. Still with me? If this is already changing how you think about your check, type the number 1 in the comments right now. It genuinely helps the algorithm show this to another retiree who needs to hear it. Now put your phone in your hand, because this next trap requires you to do something live on your Social Security statement before we go any further. Trap 3, the 35-year ghost year. Meet Mr. Callahan, 70 years old, retired union electrician from Scranton, Pennsylvania. 47 years on the tools, raised 4 kids. Wife worked part-time at the library. Hardest working man you'll ever meet. When Mr. Callahan looked at his Social Security statement for the first time, at age 69, he saw something that stopped him cold. A zero. One single zero, sitting in the year 1973, when he was 20 years old and spent most of the year bouncing between 2 short-term jobs that didn't always report correctly. That 1 zero 47 years later was still shrinking his check every single month. Here's why. The Social Security Administration does not look at your best year, your last year, or your average year. They look at your highest 35 years of earnings, adjusted for wage growth, and they throw everything else out. Anything less than 35 qualifying years, and the SSA literally inserts zeros into the formula to fill in the blanks. Those zeros drag down your primary insurance amount, the PIA, which is the foundation number everything else is built on. So if you took 3 years off to raise kids, if you had a tough stretch in the early 80s, if you were self-employed and had a bad year where you didn't report much, every one of those is a ghost year, and ghost years follow you around for the rest of your life. Here's what I want you to do right now. Pause the video if you have to. Go to ssa.gov/mysocialsecurity. Log in. Scroll to your earnings record. Look at the column that says, Taxed Social Security Earnings. Run your finger down the years. Is there a blank? A zero? A number that looks weirdly low? Because here's the good news. You can fix it. If you're still working, even 1 or 2 more years of solid earnings after your full retirement age can replace a zero or a low year inside your top 35. And when you replace it, your PIA goes up permanently. For the rest of your life. And for your surviving spouse's life if you have one. Mr. Callahan went back and worked part-time as a safety inspector for 2 more years. He replaced 2 zeros from the 1970s. His benefit went up by roughly $110 a month. Over a 20-year retirement, that's more than $26,000 from a form he pulled up in about 90 seconds. That's not a strategy. That's free money sitting on the table. And your advisor doesn't talk about it because there's no product to sell you and no fee to collect. Trap 4. The earnings test illusion. Meet Mrs. Whitaker, 63 years old, retired part-time paralegal from Raleigh, North Carolina. Claimed her Social Security the month she turned 62 because, her words, "I earned it, and I wasn't sure the program would still be there by the time I was 67. Then she took a part-time job at a law firm to stay busy. Made about $40,000 that year. And a few months later, she got a letter from the SSA, telling her that a large chunk of her benefits was being withheld because she'd gone over the earnings limit. She called me furious. She said, 'They're stealing my money. I paid in for 43 years and now they're taking it back.' I told her to sit down. Because what she believed was happening, what almost everyone believes is happening, is not what's actually happening. Here's the rule. If you claim Social Security before your full retirement age, which is 67 for most of you watching, and you keep working, there's something called the earnings test. In 2025, if you're under full retirement age for the whole year, the SSA withholds $1 of benefits for every $2 you earn, above roughly $23,400. In the year you actually reach full retirement age, the threshold jumps to around $62,160, and it becomes $1 withheld for every $3 over. Sounds like a penalty. Sounds like theft. 90% of YouTube videos call it a penalty. It isn't. Here's what nobody tells you. The month you hit full retirement age, the SSA performs something called the adjustment of the reduction factor, the ARF. They look at every month of benefits they withheld from you due to the earnings test. Then they recalculate your monthly check as if you had claimed later by exactly that many months. Which means your check goes up. Permanently. For the rest of your life. They don't steal your benefits. They hold them hostage. And most people never come back to collect the ransom. Because nobody tells them there's a ransom to collect. In Mrs. Whitaker's case, the SSA withheld about 14 months of benefits over 3 years. At her full retirement age, her monthly check was recalculated and went up by close to $90 a month for life. Over a typical retirement, that's well over $20,000. She never would have gotten if she'd believed her first instinct and stopped working in anger. Verify your specific situation with the SSA. The formulas are technical, but the principle is this: the earnings test isn't a fine. It's a deferral, and it's one of the most widely misunderstood rules in the entire retirement system. If this video has shown you even one trap you didn't know about before, drop another 1 in the comments. That's how the algorithm knows to serve this to the next retiree who needs it. Now, the next trap is the one I wish I could put on a billboard on every highway in America. Because if you've already claimed Social Security and you're regretting it, this is your way out. And you have a very specific window to use it. Trap 5. The 12-month undo button. Form SSA 521. Meet Mr. Bellamy, 63 years old. Retired regional sales manager from Boise, Idaho. His wife was diagnosed with a serious illness the year he turned 62. And in the panic and stress of it all, he filed for Social Security early, just to get cash flow into the house. 2 months later, her diagnosis was revised. She recovered, and Mr. Bellamy realized he'd locked himself into a reduced benefit for the rest of his life, based on a decision he made during the worst month of his marriage. Or so he thought, because there's a form almost no one talks about. It's called Form SSA 521. Request for Withdrawal of Application. 3 pages long. You can download it from ssa.gov right now. Here's what it does. If you filed for Social Security and you regret it, you have exactly 12 months. From the date you first became entitled to withdraw your application entirely. You repay every single dollar you received, including any amounts paid to a spouse or dependent on your record, and any Medicare premiums that were deducted. And in return, the SSA wipes the slate. It's as if you never claimed. Which means when you eventually file again at full retirement age at 70, whenever, your check is calculated from scratch at the higher rate you would have gotten if you'd waited. There are conditions. You can only do this one time in your entire life. The 12-month clock is strict. Day 366 is too late. You have to pay back everything in one lump sum, And for most people that means keeping the money in a separate account the whole time just in case. There's a single form 3 pages long that lets you press Ctrl-Z on the biggest financial decision of your retirement. And your advisor will almost never bring it up first. Because bringing it up means admitting the advice they gave you last year may not have been the right advice. Mr. Bellamy filed SSA 521 on month 11. Paid back about $28,000. Waited until 70. His check today is roughly $700 a month higher than it would have been. Over a 20-year retirement, that single 3-page form is worth close to $170,000. Verify the rules on the SSA website before you file anything. But know this, the escape hatch exists. It's real. And it's yours to use once. Now, I promise 2 bonuses. Here's the first. Meet Mrs. Hollister, 66 years old. Retired small business owner from Phoenix, Arizona. In 2024, she sold the rental property she and her late husband had owned for 30 years. The sale through her taxable income, her MAGI, modified adjusted gross income, up to around $180,000 for that 1 year. 1 good year, completely legal, completely planned. Then in 2026, when she'd long since gone back to her normal $50,000 retirement income, her Medicare Part B premium suddenly jumped by a few $100s a month. Part D jumped too. Her Social Security check, which Medicare premiums are deducted from, visibly shrank. This is IRMAA, the income-related monthly adjustment amount. Here's the trap. Medicare calculates your premium surcharges based on your income from 2 years earlier, so the check you'll cash in 2026 is already being punished by something you did in 2024. And most retirees have completely forgotten what that year even looked like. The bomb is already ticking when you cash the check. But here's the tool. Form SSA 44, Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. If your income dropped due to a qualifying life-changing event, retirement, the death of a spouse, divorce, loss of pension, and several others, you can request that the SSA use your current year's projected income instead of the 2-year-old number. Verify which events qualify directly with the SSA because the list is specific and legalistic. Mrs. Hollister filed SSA 44, documented her retirement, and got her IRMAA surcharge dropped for the following year. Saved roughly $3,000. From one form, your advisor is paid on your portfolio. Your Medicare premium is not in their revenue model. So once again, they tend not to bring it up. And now the last one. The one I save for the end of every conversation because it hits hardest. Meet Mrs. Prescott, 64 years old. Retired dental hygienist from Des Moines, Iowa. Divorced in 1998 after a 22-year marriage. Never remarried. Raised 2 kids mostly on her own. Worked 40 hours a week for 35 straight years. And her Social Security check, because her own earnings were modest, came out to about $1,400 a month. Then a friend told her something she'd never heard in her life. There's a rule in the Social Security system, sometimes called the ex-spouse benefit or the divorced spousal benefit. If you were married for at least 10 years, if you're currently unmarried, if both you and your ex are at least 62, and if you've been divorced for at least 2 years, you may be eligible to claim up to 50% of your ex-spouse's primary insurance amount, instead of your own benefit, whichever is higher. Please verify every one of these conditions with the SSA directly, because there are edge cases and exceptions. But the core rule is real and it is in the law. Here's the part that stops people cold. Your ex-spouse is not notified. Their benefit is not reduced. Their new spouse, if they remarried, is not affected. The SSA has no legal obligation to tell them. Somewhere out there, your ex could be quietly funding a portion of your retirement, and nobody has to send them a single letter about it. In Mrs. Prescott's case, her ex-husband was a civil engineer with a long, high-earning career. 50% of his PIA came out to more than her own check. Her monthly benefit went up by more than $300 a month. Over a 25-year retirement, that's close to $90,000. Unlocked by one application at her local Social Security office. If you're single after a long marriage, and you've quietly assumed the rules didn't apply to you, please, at minimum, go ask the question. Bring your marriage certificate. Bring your divorce decree. Let the SSA tell you on paper whether you qualify. So let's recap what we just covered. The advisor incentive trap. The 1984 tax trap. The 35-year ghost year. The earnings test illusion. The 12-month undo button. The IRMAA time bomb. And the ex-spouse loophole. 7 traps. 5 your advisor won't show you. And 2 bonuses almost nobody on this platform is talking about. All of them hiding in plain sight inside a system you've paid into your entire working life. Here's what I want you to do today. Go to ssa.gov/mysocialsecurity. Pull your statement. Look for ghost years. Check your provisional income. Ask about the earnings test if you're still working. Ask about SSA 521 if you claimed early and regret it. Ask about SSA 44 if your income just dropped. And if you were married for 10 years or more and you're single today, ask about your ex-spouse record. If this video helped you even once today, send it to one person you love who is 50 or older, parent, a sibling, an old friend. One share from you could be the difference between them losing $20,000 or keeping it. That's how this channel grows, and more importantly, that's how this knowledge escapes the rooms it's been locked inside for 40 years. This has been educational content only, not personalized financial, tax, or legal advice. Always verify with the Social Security Administration or a qualified fiduciary before acting. I'll see you in the next one. Stay safe after 50.